Okay, so let's finish the last two learning objectives. We'll do the gains and losses now, and then we're going to do one big problem that has 3 years that incorporates a little bit of everything we've just gone through. So, what creates gains and losses? Gains and losses are unexpected swings in pension expense that result from sudden and large changes in the fair value of plan assets. So again, if your plan asset increases or decreases in its fair value because the market changes, then there'll be changes in your actual plan asset. Or changes in actuary assumptions that affect the amount of the projected benefit obligation. So if the actuary does his calculation and comes back to you and says there's been a major increase or a decrease in our assumptions, that's going to be where your gains and losses come from. So let me speak a little bit about what corridor amortization is. This is a strategy that FASB invented in order to amortize the accumulated net gains or loss when it gets too large. So if your accumulated OCI becomes too large of a number, FASB requires you to amortize the overage. And how do you calculate what the overage is? It makes you take 10% of the larger of either your projected benefit obligation or your market-related value of the plan asset. You'll see in the problem. Any accumulated OCI net gain or loss balance above the 10% must be amortized. So anything that we amortize of that 10% is what's going to be part of your gain or loss under OCI. So here's an example. So it tells you, take 10% of the larger of the two. So you remember in our memo column in our worksheet, we have PBO and plan asset, and it has two amounts. You take 10% of the greater of the two. So in this case, the PBO is the greater one. So you take 10% of 100,000 of a million is 100,000. In 2017, you're going to take 10% of the million two, which is 120. But notice when we get to 2018, the larger of the two is actually the plan asset value. So you would take 10% of the million seven, which is 170. So correct, 10% of the larger of the two, correct. So that's how they come up with what the corridor amount should be. So here's an example. Shin Corporation has a projected benefit obligation of $3.1 million. So the PBO in this example is $3.1 million. Asset $3.3 million. Shin also has an actuarial loss of $465 in accumulated OCI. So my accumulated OCI already has $465,000 in it. The average remaining service period of Shin's employees is 7.5 years. So service period remaining. So what do we say in the corridor amortization you do? You take the larger of the two. In this case, it's your plan asset of $3.3 million. You're going to multiply it times the 10% rule of thumb that they use. You have $330,000. This is where your corridor amount is. However, we have accumulated loss of $465. So basically what FASB is telling you is you have too much. You have $465, you really should have $330,000. So you have an excess of $135,000. You're going to divide it by the average remaining service year. This is the amount you're going to amortize going forward every year. So you're going to take that $18,000, and in that column of OCI, gains and losses, that's where you're going to drop in that $18,000. Again, the slide is showing you how to do this, but when we do our problems, they're already going to give you this information. You don't have to do your own calculation. Okay? They'll tell you what the amortizable amount is. But just so you understand how FASB makes companies calculate the amortization into the gain and loss, okay? All right, so are you ready now for 3-year worksheet? So this is going to be the most complex, and after this, we're done with worksheets. We're going to jump into financial statement presentation, how all this gets presented, and then we are done. But this is the hardest, not the hardest, but the most complex type of problem that you can get on a pension worksheet. So starting with the easiest year, 2016, they're giving you what we first learned when we first started pension worksheets, the easiest of all of them, just the basic ones. Then the next year, we're going to jump into prior service costs. We're going to incorporate prior service costs, and then we're going to have everything, every scenario. So I'm trying to think, I should write all this down or not. Oh, let's see, I don't think it's going to fit up there. So the first year, 16,000 of annual service costs. We have settlement rate and expected rate of return. Why is our expected rate of return important? This is when we're going to also calculate the difference between a gain or loss. Expected rate of return versus actual return. Just remember that when we start doing the worksheets. So we start with the first year. You know what? I think we should write this down because now we're going to be jumping back and forth. So I'm going to abbreviate it. I think it's easier for you guys to reference it. Now, if you have it here, so you look back and forth when we start doing it. 2016, 2017, and 2018. Settlement rate and expected rate of return. Actual return of asset. 19. 16. 40 and 48. 14. 14. 16,421. Prior service cost plan amended. It's important. Prior service cost, and it's amended. Again, why is that important? You need to know which year to do the adjustment. 1117, 116. Amortization of prior service costs. 44. And the last thing, change in actuarial assumption. Change. So the last one is saying, the actuary came back to the company and said, your PBO as of December 31st should now be 520. So you'll see when we get to that one, why that's relevant for you to understand. So December.
Yeah, because in January 1st, we do the amendment.
Just as the team doesn't have the amortization
because it was amended as of 117, so you go forward, you don't go retro. Okay, so there was an amendment done. This was the adjustment, and the amortization going forward was 54,41,600. Okay, so here we go. We start off with the balance at the beginning of the year is going to be all zero because they didn't give us anything. Oh, did they? Did I miss something in our problem? Hold on. I didn't write down. Yes, the beginning, up here.
Plan asset.
250 and 200. So plan assets 200, PDO is 250. So that's our starting point on our worksheet. There you go. PBO 250, plan asset 20. The difference goes into our pension asset liability. Because our plan asset is less than what we're expected to pay, we have a liability of $50,000. So, next will be our service cost. 16,000 increases our pension expense, and our projected benefit obligation goes down 16,000. What's next? Our interest. 10% of our, in this case, expected, hold on a second. Yes, out of the 250, I'm sorry, is your $25,000. You're correct. Okay? Now notice here, it's getting stuck. I'm just going to open it all up so I don't have to come back. Okay, so. Yes. Our return on asset was $18,000. This came from here. Actual return on asset, $18,000, correct? Our unexpected loss. What our unexpected loss does is it takes the 10%. Do you remember how they gave us settlement rate and expected rate of return 10%? It's taking 10% of our plan asset, which is $20,000. We were expecting to make $20,000, right? But we only made 18. So that difference between the 18 and the 20 is this 2,000 unexpected loss. You follow that? You see how it falls here in your gain or loss? That's how you're going to computate that. And we're going to have the same thing happen every year because we have what we actually made, 18, 22, and 24. We're going to take what we expected to make. Now, what's going to change is this 10% comes off of your plan asset right here, right? 200. When we go on to the next year, you're going to use 10% out of the 220. Okay? So then you're going to take the difference between 22,000 and 22,000. So there is going to be no unexpected gain or loss.
Question. You use that just in case that they told you settlement and
Expected rate of return. In this scenario, they gave us both.
if they don't tell you, if they don't mention expected rate of return,
Then you don't have this column. Then you're not going to have here this.
Okay.
Correct. But in our problem, it told us that it was a settlement rate and our expected rate of return. So the slide that we went through that discussed gains or losses were two scenarios. A change in your fair value or a change in your actuary assumption, which we're going to see in the last year, in 2018. We get 2018, you'll see how it affects your gain and loss as well.
Never,
Digest it, look at it.
no, never exists the possibility that, that instead of having negative numbers, like you have a positive.
Well, in this case, you can have an unexpected gain. And it will happen. It's going to happen when we get to 2018, I believe. Almost positive, I think, when we get there, it will happen. But I won't know until we continue with the worksheet. As the percentage comes off of this number that keeps changing. You follow where every number comes from on this worksheet. Service cost is easy, because we've done it. Interest cost, again, is easy. It's your percentage of your PBO. Return on asset is a given number. Unexpected loss is new, so that's the first time you're seeing this. You take your expected rate, you calculate it times your planned asset at the beginning of the year, and then you take a look at what your actual return on asset. The difference between those two numbers is your unexpected gain or loss. Contributions we know, we've done that a couple times already, and benefits paid. So now, we add up all the columns: annual pension expense, cash, gain or loss, pension asset liability, PBO, and plan asset. How do you check your work? You take the net of these two. Does it equal your 57,000? we're good, everything balances. We can now move forward. These numbers right here will carry forward to our next year as our beginning balance. Everybody good? We have no accumulated OCI here because there was nothing at the beginning of the year. So these two, that's why they're 0. All right, now notice how these numbers down here are going to go on to the next sheet when we move on to the next year. Well, here's your journal entry for 16, and then we move on. So, now we start with the beginning of 17. All those figures carry forward from the 12/31/16 worksheet. Here, 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 and here. We go to our 2017 fact patterns. So what's new here? Well, we know that we had an amendment to the plan of $160,000. So we're going to have right here $160,000 that's going to come before we start our worksheet. So here's where my 160,000 goes. It goes on my prior service cost OCI column, and it goes against my projected benefit obligation. So why is this important? Because when we calculate our interest of 10%, that goes here, it's off of the adjusted number. So you always have to make sure that if you have an adjustment, an amendment or adjustment of prior service costs, that you take your interest on the adjusted balance, not your beginning balance. Now, as I was mentioning in the slide before, notice how here we do not have an unexpected gain or loss. Why? Our return on asset that we actually got was 22,000. Our expected is 10% of our planned asset, which is 22,000. So there is no gain or loss. It's 0. That's why there's nothing here. Good. Good. Amortization of prior service costs, 54,000 under our annual pension expense, and 54,400 under prior service costs under OCI. Your contribution, your benefits. So here's what we now start using accumulated OCI. There was nothing here, that's why it's a 0. There was 2,000 here, that's why the 2,000 comes here. Accumulated OCI, it's only OCI. So, our journal entry, debit to 95,100 to pension expense, credit $40,000 cash, debit OCI for prior service costs 105,600, and then our pension asset liability is 160,700. This is needed to make your entry balance. We're going to check if this is correct. 217,700. The net of these two is 217,700. This is always a plug. This is what number do you need here to make your journal entry balance. So you would do 95,000 minus 40 plus 105,600. What do you need as a credit to make your entry balance? Okay. And to check if this number is correct, if you want to make sure this number is correct, you add up this column, you take the difference of these two. If that number equals that, you're in balance.
Easy.
It's all about just taking your time and dropping in the numbers in the correct place. If you don't drop it in the correct place, you know you're going to be wrong because it won't balance. It'll just be off. When I taught this class 2 semesters ago, that's how they would check to make sure if they were correct or not when they would do the homework. Didn't balance, and feel free to email me. They would email me halfway done and they're like, I'm stuck, I can't figure out where the problem is. And I would be like, here, your issue's on this column. Go back and look at this column. Okay? So we're gonna do the last year now. So again, these numbers will carry forward to the next year. All across, 105, 2000, 217, 483, 300, and 265, 600. Not gonna go through the detail of journal entries, because you guys know the journal entries. So here we go. You see how it comes right up here, beginning of the year? So, on this year, we don't have any amendments, nothing here, so that's why we don't have any adjusted, beginning balance. So we're gonna jump right into service costs. The only difference in 2018 that we didn't have in the prior years is going to be this change in actuary assumption. And you're gonna see how we come up to that. So basically what that is saying is that whatever number comes out here at my PBO, we have to go back and adjust it to make it equal 520. It's not gonna equal 520. That is one of the facts. It's saying, they came back and told the company, you should have 520 as your PBO as of 12/31. You're gonna see how we fix it on the journal entry. Okay. Service cost comes right off our facts, 26,000. Interest is 48,330, which is 10% off of your PBO. Return on assets, we got it from the 24,000. Unexpected loss, all you're going to do again is take 10%.
The 48,330, the 10% of the sum of the.
Of the PBO, your beginning balance of your PBO.
Oh, then I don't have to add 26 to.
That's when we're doing, that's not that row, that's unexpected loss, okay? So just start memorizing these things. Interest is always off of your beginning balance of your projected benefit obligation. Your unexpected gain or loss is when you take the difference between your expected rate of return, which is 10% of your plan asset, plus or minus depending on your actual return. So in this case, we were expecting to receive 26,560, but we only received 24,000, so we had a loss, an unexpected loss of 2,560. Okay? And it goes on this column here, gain or loss, OCI here. Moving on, amortization of prior service costs. This was a given number they gave us here, 41,600. Goes under your annual pension expense and PSC. Contributions, benefits paid. Okay? Now we're going to do the 520. So this number right here is a number that we calculate to come up to find out how much we need to get to 520. So you would have added 43,300, 26,000, 48,330. You would have added 21,000, whatever that number was. You take the net of that to 520, and this is a plug number. This is a number we have to put here to make this equal 520 because our problem says that as of December 31st, 18, our PBO needs to be 520. Does that make sense? Now, this could be a plus or a minus depending which way this number needs to go. So if this would have been a minus, it would have been a plus here. But in this case, we needed to add 16,630, so that's why it's a loss of 16,630.
So when you add all of them, you have more than 520?
Correct. You adjust it based on what you need to get this to equal the information it gives you in the problem. We carry down our beginning accumulated OCI, 105, 2,000. These are your balances. The net of these two, 203,400, 203,400. And our journal entry, right here. We'll read this entire thing right here. Easy?
No. What is it? What is
Which one?
the first one, 2, 3, 4?
I'm I'm sorry, which number?
2,400.
203,400. 217, or negative 217 plus 14,300.
Eso que tú me dijiste ahorita, estás mirando el día.
No, no, aquí tenemos así, pero
Parentheses.
así que no saben meter ahí. No saben el cálculo.
Porque vos estás en un momento ahorita, estás mira, de la mano para abajo.
So in order for your journal entry to tie, we're gonna debit annual pension expense, we're gonna debit pension asset, and we're gonna credit, and that's how your journal entry is gonna tie. Well, this is for companies to record all the pension on their balance sheet and on their P&L. So again, we were talking, this is not tax related, this is auditing. So if you do auditing, you as an auditor would make sure that companies are recording their pensions correctly. So this is for presentation purposes. So that when somebody looks at your balance sheet, they say, okay, this company has a pension plan, and look, great, it's overfunded. Oh no, it's underfunded. You get what I mean? That's how you come up with these amounts for people to read your financial statements.
Oh, if I don't, it will be, I don't need this.
Correct. But it's not only if you're not audited, but if you are, imagine you're the owner of your company, you want to know if your pension plan is overfunded or underfunded. And your accountants are the ones that put these calculations together for you. So this is, again, the most complex you're going to get into on the pension worksheets. But once you get the hang of it, where things fall in your worksheet, and as long as everything balances, it's fairly simple. The positions of where it ends on your worksheet doesn't change. It's always going to be in the same place. Just on some items, it might be either a positive or a negative. We just discussed. Okay, so the last section. Describe the requirements for reporting pension plans and financial statements. So this is just now everything we've learned where it goes on your financial statement. So within the financial statement, we need to record recognition of the net funded status of the plan, classification of pension asset or liability, aggregation of pension plans, actuarial gains or loss of prior service cost. In your notes, you're going to list the major components of your pension expense, reconciliation showing how the projected benefit obligation and the fair value of the plan assets changed, and a disclosure of the rates used in measuring the benefit amounts, whatever discount rate, expected rate of return. So all that information that they gave us in the problem, all that has to be disclosed in your notes of your financial statements. And again, it's important for your users to understand what rates you're using, because if you're using rates that are not realistic, they need to know that. You also need to include a table indicating the allocation of pension plan assets by categories. So remember how I told you this last column here is always the administrator where they're investing your money? They are required to tell you where the money is being invested. Is it in equity securities? Is it in debt securities? Is it in real estate? Where is the money being invested? And showing the percentage of the fair value. Yes. So the administrator takes the money and invests it. That's how they get it to grow. They have to disclose where it's being invested in. The expected benefit to be paid to current plan participants for each of the next 5 fiscal years. So they have to include a note that says in the next 5 years, this is what we're expecting to pay to employees that are retiring. And an aggregate for the 5 fiscal years thereafter. So 10 years in total. Also requires a disclosure of the company's best estimate of expected contributions to the plan during the next year. So they have to come up with what they expect to be contributing. The nature and the amount of changes in plan assets and benefit obligations recognized in net income and other comprehensive income for each period. So the OCI part would come off right of our worksheet. and the accumulated amount of changes in plan assets and benefit obligations that have been recognized in OCI income and that will be recycled into net income in the future period. And I believe this is finally the amount of estimated net actuarial gains and losses and prior service costs and credits that will be amortized from accumulated other comprehensive income into net income over the next fiscal year. That is the amortization schedule we did for 5 years. It's just that's what it's asking you to do. That 5-year calculation, they want it in the notes so people are aware. And Pension Reform Act, this was just, yeah, this is the appendix. I'm not going to go into the appendix. I don't ask any questions on your quiz on the appendix. That's it.
Every week we have the assignment and the quiz.
And the quiz, 10 questions.
You don't tell me about the quiz, but realize that I forget that.
It's fine. It's all the information that we learned in the class.
Yeah, but I don't see the quiz.
It's multiple choice.
Yeah.
10 questions.
I mean,
Everyone
That's
that's-
multiple choice.
yeah,
The multiple choice, you need a lot of the multiple choice to hold it in order to get the problem solved. And it's 1 hour.
it don't close, it closes everything on Sunday or no?
No, it stays open.
It's
Everyone did fairly good on the first quiz. The people that have taken it all have done fairly good, so I don't think it's that difficult.
No,
If I don't pick the question, the thing is it's a bank of like 100 questions, so it just automatically picks 10 questions. I don't really put in there what questions it picks. So if I see that people don't do well, obviously I'm lenient and things like that, so.
No, the problem is not like the question, it's the time.
I know but not all of them come out as problems. Some of them are just conceptual. I think out of 10, I think 1 or 2 come out problems, the rest are conceptual. How many did you get problem?
probably like 4 or 5.
Really?
Oh, yeah.
I have like 3 or maybe 4 or maybe half and a half. I'm not 100% sure right now.
But I think you did good. I think I saw your grade too.
No,
I think you got like a 90 or 80,
No, I get 100.
100?
Yeah, but my problem was the time. I was like, oh my God.
Yeah,